All right, good evening or afternoon, depending on where you are. And it's great to have everybody here. My name is Ray Kimbrell. We got Scott Durfee and the Ben Watson for our Advanced Options Strategies Workshop. Glad you're all here. And let's go over a couple of things before we get everybody in. And I'll start introducing Scott and Ben here in just a second. Just want to remind everybody, got great news. If you've been on our virtual workshops in the past, this one is going to be recorded. And so I know we'll get this question a million times throughout the night or throughout the day. But yes, we are recording this session, and you'll be able to find that recording. If you go back to your email, go back to the hub, the education hub, and you'll be able to see the recording once it's been approved and posted. All right, that's the good news there. And the other thing is we are going to have a Q&A session on Friday morning. Do know that it's only an hour-long session. And the way to submit questions for that is to go back to the hub as well and submit your questions through that. And the great news there is Ben will show you how to do that later on in the class. So get ready for that. It'll be a lot of fun. All right. But I want to do one more thing before we get going. I do want to introduce my great friend, the Scott Durfee, who's there. I'm here in Texas, and Scott's out there in Utah. Scott, say hi.
Hey, everybody. It's good to be here tonight. I don't want to take any more time than that, Ray, so back to you.
All right, buddy. Good to have you here. And Scott and I will be doing the best we can to keep up with the questions in the chats. There's a whole lot of you all, and I will tell you right now, we probably won't be able to get all the questions in the chats answered, but we'll do the best we can to hit them as you move along. And Ben's really good at it as well, to pick it up the questions he sees, and he'll answer them on as live as we go. So be patient with us, please. I ask you that one kindness, and we'll do all we can to help you out with questions as you roll. All right. Iron Condors are the subject tonight, and do know that that is an option strategy, and options do carry their own unique kind of risk. Understand those risks, and before you get into those trades, do know that if you use paper money account, that paper money account is not a real account, is simulated, and there are some subtle changes and differences in there, and especially when you go back to a live. So understand that it's a great tool to practice with, but success when paper money does not necessarily guarantee success with live money. Do understand the different risks associated with options before you get into those trades, and we hope you had a fun time tonight. So let's get Ben Watson onto the stage, as we say. We go do these live as well, but we're all coming to you live, but virtual. And you can see Ben's been doing this for 1 or 2 years, 2005. He is the host of Your First Trade on the Schwab Network, which is brought to us by our separate but affiliated company, Schwab Media Productions. And you can see he specializes in teaching the Thinkorswim platform, technical analysis, stocks, options, you name it. He can teach it. And we're very proud to have Ben with us. He's a great man, a great friend, great dad, and a great instructor. And I think you're going to agree with that when you see it. So with that, Ben Watson, the man, the myth, the legend, there it is. Take it away, Sir Ben.
You got it. Thanks, Ray, and thanks to Scott. And I appreciate you guys being here. You guys are phenomenal in supporting what we do. Here's a quick reminder of who these guys are. Scott's been doing this since 2006. Frequent contributor on the Schwab Network. Ray's been doing this since 2004, also frequent contributor on the Schwab Network, and both contributors to my show on the Schwab Network, Your First Trade. So appreciate these guys being here. We're going to jump right into our discussion this evening, and I want to thank everybody for coming back and for being with us and for joining us again tonight. If you're brand new, thank you for stepping into this workshop, and we appreciate you being here. We're going to show you all of those resources along the way, including where to get the slide deck for this discussion, or the resource guide, if you will. That will have more of the slides than the ones that we're going to use in this discussion tonight. And we're going to talk a little bit as we get into this discussion tonight about Iron Condors. Last night we focused on long vertical spreads. Tonight we're going to focus on Iron Condors, and primarily short Iron Condors, although we will talk a little bit about flipping that over and talk about a long Iron Condor, considering the fact that we've talked about long vertical spreads. So we'll talk about the various conditions that might make sense for using an Iron Condor, really kind of answering the why question, right? Why would we use this particular strategy? So with that in mind, let's jump into this discussion and talk a bit about why we might use Iron Condors. And Iron Condor is primarily a strategy designed to allow the opportunity to take advantage of neutral price movement, but not just neutral price movement that is neutral to bullish or neutral to bearish. Because one of the great things about an Iron Condor strategy, especially a short Iron Condor strategy, is that it becomes a function of allowing a stock to really do what it's going to do. And ideally, an Iron Condor benefits from a couple of things that we know are either inevitables or maybe have a higher probability. One of those is the passage of time. The other is perhaps a change in implied volatility. So as we put these trades together, as always, the influences on our trade are going to be price direction of the underlying stock, time, the passage of time, and changes in implied volatility. Now, we've seen a little bit of change in implied volatility. We've seen some directional price movement, but at the same time, the market at the moment, the broad definition of the market is kind of sideways. So maybe an opportune time for us to be talking about Iron Condors. And so this is going to be our focus and our goals for this session. We're going to talk about these ideas. We're going to put these into practical application. So really, if we think about what an Iron Condor is made of, and when we talk about all of these kind of advanced strategies, when we talk about an Iron Condor, we talk about a butterfly, we talk about a diagonal, or we talk about a zebra, or whatever other animal it is that you might put together. All of these trades are really, truly, simply using the building blocks of options. We know that there are 4 things that we can do with an option. We can buy a call, and we can sell a call. We can buy a put, and we can sell a put. Those are the 4 things that we can do with an option. And the rest of how we put those strategies together simply depends on how we snap those building blocks together. Last night, we snapped together the building blocks of a long option and a short option. The long option was the more expensive, and that was the driver of our trade. The short option, the less expensive, and that helped to offset some of the cost of the long option. Tonight, our focus is going to be a little bit different. We're going to be snapping together a long option and a short option, but in this particular case, the long option and the short option are going to kind of reverse roles. The short option is going to be the more expensive, so the long option is going to serve as protection against that short option obligation. And then when we put those 2 building blocks together, we've got a short vertical spread. When we put a short call vertical spread and a short put vertical spread together, then we come up with an Iron Condor. An Iron Condor is simply an Iron Condor, meaning that it has a short vertical spread on both sides. It has a short call spread and a short put spread. That's what gives it the iron component of that trade. And so if you're interested in the nomenclature, that's a little bit of the basis of how that name came about. Now, when we talk about a condor, and the reason that it's called a condor is simply when we look at the risk profile graph, it looks like a bird with wings outspread. And you'll see what that looks like here in just a minute. So the slide that I have on the screen right now gives us one side of an Iron Condor. And in this particular case, this is a short put vertical, which has a bullish bias. Last night, we talked about long put verticals, which had a bearish bias. And we did a couple of examples of those. In fact, we did a number of examples of those that were looking for bullish movement, bearish movement. Some of those worked out. Some of those did not. And I acknowledge the fact that a couple of people said, hey, KMX, the example that we used last night, might bounce. So good call on your part. And that's one of the reasons why we look at trades the way that we do when we look at a number of examples, and we don't have any way to predict the future. But as we put this short put vertical together as the structure of the trade, right? As we put this together, again, short vertical spread, as opposed to a long vertical spread, is going to benefit generally from higher implied volatility to begin with the expectation that implied volatility is going to fall. That's going to work in the favor of the trade, the short component of the trade being the idea that we're going to sell it high and buy it back low. We want to sell that vertical spread when it's expensive, and we want to buy it back when it is cheaper, as opposed to what we were doing last night with long vertical spreads, buying them cheap and selling them when they are dear. So this is a little bit different. We're kind of switching sides here, and I want to make sure that we're aware of that. Now, the idea being we're putting together the short put vertical and the short call vertical. So here's a short call vertical on the other side of the equation. The short call vertical has a bearish bias. So if we've got a bearish bias, we're selling a call and expecting the price of the stock to stay at or below that level, and we're buying a call to provide cover for the obligation that short call option creates. And because that has a bearish bias, and because we've already put on a short put vertical spread, or we've already structured a short put vertical spread, we now have created a bracket or an area around which we expect price to stay. And that really gives us our function of an iron condor, is for that neutral to slightly bullish, slightly bearish movement. Nevertheless, we're expecting range-bound movement. Doesn't mean that we expect the price of the stock, the underlying stock, to stay exactly where it is. But how we structure the trade gives us the size of the bracket or the range or the channel in which we expect the price of the stock to stay. So now that we have kind of that idea of the short put vertical side and the short call vertical side, it looks something like this. We're combining a short put vertical spread and a short call vertical spread. We looked at both of these types of risk profiles last night, but you can see that the short put vertical bullish expectation, short call vertical bearish expectation, this becomes a traditionally delta neutral trade, because if we combine those, we push them together, now we create that iron condor risk profile. So we start to see that scenario happening here. It has a defined return and it has a defined risk. Just like our long vertical spreads last night, the iron condor is a defined risk trade, even though we are short a vertical spread on top and a vertical spread below where the price of the underlying stock might be. So this is an income generating strategy. It could potentially be a hedging strategy, but generally it's designed to bring in premium. And the great thing about an iron condor trade is the characteristics of the trade allow for some flexibility in terms of the duration of the trade. Some traders may trade short-term iron condors. Some traders may trade longer-term iron condors. I noticed somebody in the chat saying, hey, iron condors work really well as like a diagonal spread where you've got a longer expiration date on the long leg and a shorter expiration date on the closer into the short legs of the trade. Now, we'll talk about that, so keep a pin in that, because when we get to diagonal spreads on Thursday night, we're going to talk a little bit about those kind of combinations of diagonal spreads. But the other great thing is that for those of you that might be interested in trading shorter term trades, 10 days to go until expiration, 5 days to go until expiration, or even 0 days to go until expiration, an iron condor is a strategy that can take advantage of neutral movement, whether you're talking about a long time to go or a short time to go until expiration. We'll talk about some of the exit considerations in those strategies. Now, one thing to remember, if you're trading 0 DTE options, and this is an important consideration to keep in mind, there are some things to think about. One, gamma is going to become a much more influential option Greek, in a 0 DTE environment, meaning the price of the stock could move that option spread or that iron condor in the money or out of the money on one side or the other, or both, not at the same time, of course, but one after the other very, very quickly. And so it's important to pay attention to the option Greeks, especially as you get close to expiration. Number two, if you are initiating a spread trade or any option trade in that 0 DTE time frame, there is the possibility that because of the potential for adverse movement, that the order just doesn't get executed or that it is prevented from being executed. So that's an important consideration in looking at those trades. I'll show you some additional resources for that as well, but I wanted to address that because I know that there are a number of you in this discussion tonight, and I've seen it in the chats, that have been asking questions about 0 DTE trades. And so we certainly want to recognize the fact that that is a valid component of these types of strategies, and we want to be aware of that. DTE, Jeffrey, stands for days till expiration. Days till expiration, DTE, days till expiration. That's part of the nomenclature of this discussion. Now, Gary brings up a good point. An Iron Condor carries with it a risk of early assignment. Now, we talked about the scenario last night in terms of early assignment. In a long vertical spread, early assignment actually puts us in that situation of being in the money on both legs of the spread, or being having to satisfy the obligation, but we have the long leg to satisfy that obligation. Being assigned early in a long vertical spread oftentimes results in theoretical maximum gain. On the other hand, being assigned early in a short vertical spread is perhaps something that a trader may want to avoid having happen to them in the trade. So it's something that we'll talk about as we get into management of these spreads. So we'll get into that portion of the discussion here really quickly. So there's our risk profile graph of our Iron Condor trade. Maximum gain is the premium that we're going to bring in. Maximum theoretical loss is the difference between the long and short strikes of the vertical spreads minus the premium we bring in. So it's something to pay attention to as we calculate and put together these spreads. And again, they give us a lot of flexibility. And we've got break-even points. In fact, in a short Iron Condor trade, we're going to have 2 break-even points that we have to pay attention to. One if the price of the stock goes up, one if the price of the stock goes down. So we're going to talk about this as we get into this trade. I'm going to pop over here to the Thinkorswim desktop software platform really quick, just now that we have that kind of why behind the trade in mind. Okay. So here's the S&P 500. This is the SPX index. And I wanted to bring this up simply because I want to illustrate the neutral movement that the market has been making over the last few days. So I'm going to zoom in here a little bit. This is the Thinkorswim desktop software platform, specifically the paper money version. This is a demonstration account that is made to look like and operate like a live account, but I assure you that this is a demonstration account. Any of the symbols that we look at are simply for illustrative and educational purposes only. So what you notice about the S&P 500 and really kind of that broad definition of the market is that it's kind of been moving sideways over the course of the last week or 2 weeks. If we look at the NASDAQ's been a little bit more bullish. We look at the Russell 2000 in terms of the small caps, that has been perhaps also a little bit more sideways. So we're going to look at a couple of different scenarios. We're going to look at examples that exist in the NASDAQ, which are a little bit more bullish or a little bit more bearish. We're also going to look at examples that will sit within the SPX or both of those areas that are maybe a little bit more neutral in their approach. So the tools that we're going to use tonight, we're going to use the Trade tab, we're going to use the Analyze tab, and we're going to use the Charts tab. So I wanted to show you really quickly here an example trade that I put on earlier today so that you can see how these Iron Condors are constructed and how they work. Now, before I go to the Monitor tab to show you that, I want to do one more thing. I'm going to change my grid view to the VIX, the volatility index. And we talked a little bit yesterday about the VIX being low and that being a benefit to long vertical spreads. Well, the VIX is still relatively low. We're still currently sitting at about a 16.5 handle on the VIX. It popped up a little bit today and then bled back off again. That's typically the nature, just as it's the nature of a scorpion to sting, it is the nature of the VIX to move higher and then come back down, or move lower and then come back up. It's mean reverting. So we look at where the VIX is now, and it's relatively low. So overall, I just want to set the expectation here these are not going to be overly juicy iron condors kind of across the board, simply because there's just not a lot of volatility in the market at the moment. Individually, stocks will have their own levels of implied volatility, and some are high and some are low. But I had to look long and hard to find those that had extraordinarily high implied volatility. Now, we are in the middle of earnings season, but nevertheless, some of those implied volatility numbers and those current IV percentile numbers that I showed you last night, still on the lower end of the scale. Now, it doesn't mean that we can't trade iron condors. It simply means that we're probably not going to get as much premium as we would receive otherwise in putting that trade together or utilizing that trade. So you can certainly still trade iron condors in a low volatility or low VIX environment. It's just that the iron condor is benefited by high and falling implied volatility. So that's a good idea to keep in mind as you put these trades together. So let's take a look at a couple of the trades that I put on today. And I put them in our Advanced Options Virtual Workshop group here. And I've got three. I've got a couple of different, now all three of these have earnings announcements coming up kind of over the horizon a little bit, right? And all three of these have different times to go until expiration. The Disney trade has 31 days to go until expiration. My McDonald's Iron Condor has 24 days to go until expiration. And my Decker's Outdoor trade in this particular illustrative example is 10 days to go until expiration. Yeah, that's how I got the VIX. I just put it in the block. I happen to have a pre-built that I've built grid that shows the VIX and a couple of other things. I just wanted to show the grid, but you can certainly put, Mary, the VIX in the symbol box and bring up the VIX, the volatility index. So let's do this. Let's start with the longest time frame Iron Condor in this particular group, 31 days to go until expiration. And this is on Disney, Walt Disney. Symbol is DIS. And I will just show you the characteristics of this particular trade as I put this on, right? So I sold this Iron Condor trade for $2.62, and it is currently trading at $2.61.5. So it's starting sort of to work in the direction that I want it to go. But I just put this on today, so it is early in the lifespan of this particular option, or these particular options. These are all in the same expiration month because these are vertical spreads. Okay, so here's what we're going to do. And we're going to take a look really quickly. I'm going to go to my charts. I'm going to change my grid to my single grid, which is just my playground, my sandbox, for looking at trades. And I'm going to bring up DIS is the symbol. And here's Walt Disney. And a couple of things that I notice on this particular chart. I'm going to zoom in on a narrower time frame here. It's been in an uptrend. Some of you were with me earlier today in my Getting Started with Technical Analysis webcast, and we talked about trend. If you want to learn where that is, I'm going to show you those resources here in a little bit. But take a look at what's going on with the price of Disney over the course of the last couple of weeks, right? This price has really kind of been going sideways. I'm going to grab my magic marker, and you can see this level of support maybe down around here, and the price has bounced up, and it's bounced down, and it's bounced up a little bit, and it's bounced down. So generally, that price has kind of stayed within a narrow range, right? Those navigational beacons have kept the price of the stock in between levels of support and resistance. It doesn't mean that it can't move out of that range. It just means that's where it's been staying for a little while here. Now, the other thing that I happen to notice on this particular chart is this, and that is the fact that implied volatility was down here at a low, and it has been rising. Now, typically, this is a stock where implied volatility will rise into an earnings announcement and then start to fall prior to that earnings announcement. You can see what's going on here now with implied volatility. Generally, it has been rising. If we zoom back out on this particular chart and we see where that level of implied volatility is relative to where it has been, let me just kind of zoom out on this chart. You can see that implied volatility has been a lot higher. Implied volatility has been up around the 68% level as a high coming into that April low Now implied volatility is sitting right about 34%. And that puts us in kind of the lower range of implied volatility if you take into account that big spike in April. If you were looking at where implied volatility normally is, it's not the highest it's been, nor has it been the lowest, right? So implied volatility relatively high, and you can see what's already starting to happen. It's starting to roll over a little bit and come back down. That benefits us as the seller of an Iron Condor, that high and falling implied volatility. Okay. All right. So how did I get implied volatility on the chart? I went to the flask icon up here at the top, and I typed in the words IMP, implied volatility, and I put that study on my chart, implied volatility right there. That's a simple native study within the Thinkorswim platform, and that range that range of implied volatility looks back at whatever the time span is of the chart. Okay. So I've got a level of support down here at about 118, and I've got a level of resistance where the price of the stock has run into up around the 125 level, right? So let's look at how we put this trade on. I'm going to go to the trade tab, and I'm going to go out 31 days to go until expiration. This is the 22 August expiration. Now, one thing I know is that just by looking at implied volatilities over here on the right-hand side, I'm probably going to live through, if I were to hold all this trade all the way through till expiration, I'm going to live through where that earnings announcement likely is, right? The earnings announcement is probably in this 8 August expiration, about 17 or so days to go until expiration. The reason I know that is because that's where I'm seeing a little bit of elevated implied volatility, right? A little bit of elevated implied volatility. And because that's elevated implied volatility, that's likely to indicate that's where there's an earnings announcement. I don't know that for sure, but I can look here in the information about the underlying, and I can say, hey, where is the next earnings announcement? I can actually go to the chart, and I can look over the horizon, and I can add a little bit of time out into the beginning here. So we're 10 bars out. I can go 50 days out, in this case, since it's a daily chart. And I can see that that earnings announcement is on the 6th of August. There you go, right there. It's in that expiration week. So that's where that implied volatility is. So Daniel says, should we sell the Iron Condor after the earnings? Well, here's the thing to think about. Remember, we're talking about implied volatility here. Implied volatility tends to ramp up prior to the earnings announcement. It tends to fall almost immediately thereafter, or even a little bit before. So we can benefit from that. Now, the risk is, the other side of that challenge is the earnings announcement can bring new information into the system, and it can create stock price movement. So the stock could move out of that range. We've seen Disney on earnings, in fact, on the last earnings announcement, make a big gap up on that earnings news. So there is a risk there from implied volatility, but that is always the case with higher implied volatility. There's a greater likelihood of stock price movement, something to be aware of as you put the trade together. So now, as we get into this discussion, let's drop back into our trade tab, and let's open up our 22 August expiration. Now, the other thing that I want to pay attention to is this potential move right here. That is the expected move of the underlying stock within that time frame, up or down, and that's about 9 points from where it is right here. Now, I actually, in this particular case, went in a little bit inside that range, because what I know is that this oftentimes, especially after an earnings announcement, tends to over-expect price movement. It tends to overprice that expected move. So we go to the 22 August expiration, and what I did to create this trade, I'll show you how I did this, and you can walk through this as I do this. So I went to the 118 strike, and remember, the 118 put strike, that 118 level is where I had a level of support on the chart, and I sold the 118 put. Okay, so I'm going to just hold my control key down on my keyboard and left click on the 118. We're going to just replicate this trade. So now I've got an order down here. If I'll pop this back up again, an order to buy the 22 August 118 put option for $2.73. And I'm going to make this a short put vertical spread by buying the 213, 5 strikes wide, or $5 wide in this particular case, right? So 118 to 113 is $5 wide. and I'm going to buy that one. Now, you notice which one is more expensive. The one I'm selling is more expensive. So this is going to be a credit spread. I'm going to get paid for this, right? Now, in this particular case, I'm getting $1.31 on a $5 wide vertical spread. And if I were to just stop right here with this trade and click on confirm and send, my max loss in the trade is $5 minus the premium I'm bringing in, $131. So my maximum loss in the trade is $369. But I think we can do a little bit better than that. Now, in this particular case, if I were to just stop right here, I've got a bullish bias, and I expect the price of the stock to go up. That's fine. As long as at expiration, the price of the stock is above my short strike, which is the 118 put option, then these options would expire worthless, or I could buy them back for a lot less than I was paid for them to begin with, and I would collect the majority of the potential gain in the trade. But remember, Disney is in a channel at the moment. So I'm going to take advantage of the fact that Disney is moving in a channel. And I'm going to drop this back down, and we're going to come over to the call side, right? I'm going to come over to the call side of the equation. And you remember I said that I had that resistance level up here at about 124, 125. So I'm going to go to the trade tab back again, and here's my 125, 126 strike. I, in fact, sold the 125, I sold the 126 strike in this particular case. And that's about a 35, 36 cent delta. We'll talk about delta here in just a second. But I'm holding my control key down on my keyboard again. I sold the 126 strike, and I bought the 131. Again, $5 wide. So what I've done is I've created a short call spread above and a short put spread below, $5 wide on either side. Short call spread above, short put spread below. Short call spread expects price to go down. The short put spread expects price to go up. And so ultimately what I'm left with is a neutral movement expectation. I expect the stock to stay in between my short strikes, below 126 and above 118. So I've given myself a range in which I expect the price of that stock to stay. Now, remember when I just was looking at the put spread, I was bringing in about $1.31 in credit against a $5 wide spread. Now I've doubled basically that credit on the trade, so $2.61. But if I click on confirm and send, my risk has gone down because I still have a $5 wide spread above and a $5 wide spread below. And I know that at expiration, I know for a certainty that the price of the stock at expiration cannot be both above my short call spread and simultaneously below my short put spread. Okay. I won't be at expiration both above or below at the same time. Now, I could be one or the other, but not both at the same time. So my risk is only the width of one side, that $5 width of the spread between the short leg and the long leg. So that means this trade at this point is roughly 50-50. I have a maximum theoretical profit of $2.61 times 100 shares, and I have a maximum theoretical loss in the trade of $2.39 times the 100 shares. So max gain, 261, max loss, 239. Let's do this. Let's send this over to the Analyze tab here really quickly. I'm going to right-click, and I'm going to click on Analyze Trade, and I'm going to put this over on the Analyze tab. And let me kind of adjust this so that you can see this a little bit. There's our Iron Condor. I'm going to spread this out, and you can see where those prices are. Remember, this is profit and loss on the y-axis, and this is stock price on the x-axis. So let me grab my magic marker, and we'll kind of walk through this risk profile graph. And then I'm going to show you some resources to help you to understand this a little bit more, maybe spend a little bit of time learning about the Thinkorswim platform. So notice my 118 strike and my 126 strike are right here. Those are at the top. My 113 and my 131 are right here. Those are my long legs. So here's where this trade benefits, right? Here's where the trade benefits. The trade benefits if at expiration, the price of the stock is anywhere in between those two strikes at expiration. That's where I would get theoretical maximum gain. Now, if the price of the stock is a little bit higher or a little bit lower at expiration, I'm going to get some potential gain in the trade. If the price of the stock is below my break even, here's my break even on the call side, or on the put side, here's my break even on the call side, and you can see where those levels are. If the price of the stock is a little bit below that or a little bit above that, I'm going to take some loss. Where I get to maximum theoretical loss is if the price of the stock is below 113, right, or above 131. So I'm going to just label that max loss theoretical or max loss theoretical if the price of the stock makes a big move one way or the other. Cool, right? So that suggests that if the price of the stock stays within that channel that we'd already identified from a technical analysis perspective, this range is where we would get theoretical max gain in the trade. I'm going to make that a T right there. Max gain theoretical comes within that range. Does that make sense so far? Does that structure make sense? We've combined those two vertical spreads, those two short vertical spreads, short call vertical, short put vertical spread together in that range. And we've defined the channel in which we want the price of the stock to stay. Cool. All right. So that's what we are looking for. Now, let's talk about this for just a second. We can hold this trade all the way till expiration. We don't have to. We can look at taking the trade off. In fact, we may want to, like we did with our long vertical spread last night, take this trade off when it has done the majority of the work that it can do for us. Now, we've looked at the Analyze tab here a little bit. We've talked about how we can use this Analyze tab. If you want to learn more about the Analyze tab and how that Analyze tab can help you, I'm going to show you a resource to be able to do this. So there's our risk profile graph that I showed in the slides before, right? Where our break-even point, our max gain, max loss occurs. But if you want to learn more about the Thinkorswim platform and become more adept at using this, here's a way that you can do this. We showed this last night, but this is a great resource. Our Trading Solutions group will do a 45-minute walkthrough with you to be able to help you set up your platform, to learn how the platform operates, to learn things about the Analyze tab or about the Charts tab or about the Trade tab or the Options chain. All of those things are available within that 45-minute walkthrough. So click on that QR code or hit that URL link down there at the bottom of the page. And Ray and Scott are going to put that in there. I think they've got that link that they will put into the chat for you so that you can click on that and you can log into that calendar page and allow you and get signed up for that information, right? Okay, so with that in place, I'm going to leave that up there for just a second. And we're going to talk about a couple of things because I've noticed a couple of questions that have come up. One is the question of, could we make tighter spreads? Could I go $2 wide on either side? And the answer is, yeah, you could. Could I go wider? Could I make those spreads $10 wide? Yeah, you could. Could we go closer to the range of where the stock is? Yes. We're probably going to collect more premium, but there's a greater possibility of the trade ending up in that maximum loss scenario because the stock could move up or down. Could you go wider out? Yeah, you could. You could widen out the spread. You're going to collect less premium, but it gives the stock a bigger range to move within. The other thing to think about, too, is duration of the trade. Could we go longer in our duration? Because we went 31 days to go until expiration. Great. That's cool. That benefits from the passage of time, but it also puts us at a point where the passage of time is relatively slow. Could we go shorter duration on the trade? Could we go closer to expiration? And the answer to that is absolutely yes. And we're going to benefit more quickly from the passage of time, but we're also going to collect less premium. There is always, guys, there is always a trade-off in how we construct multiple leg option strategies, including Iron Condors. And just as there's a trade-off in how you put together a long option or a short option, there's a trade-off here when you combine those into another trade, right? So that's kind of the structure of how we put this together. So there's that link. I put that link up there. I'm going to pop back out here to the Thinkorswim platform, and let's talk a little bit about where we put this trade together. So I'm going to go back to the trade tab for just a second, and we're going to talk about this trade. So we're short the 118 and we're short the 126. So let's take a look at these individual legs in the context of the option Greeks, right? In the context of the option Greeks, let's use our short put spread first, right? We are short the 118 strike. That's this one right here. So that has a delta sensitivity. And you remember the option Greeks, delta tells us the directional sensitivity of that option. That has a directional sensitivity of 36 cents. Our 113 strike has a delta sensitivity of about 22 cents. So the net sensitivity of that trade is about 14 cents. So again, we're creating a delta neutral trade. We expect neutral movement in the price of the stock. But what's the other way that we could use delta in this context? Delta can oftentimes be used as a stand-in, if you will, or a thumbnail sketch of the probability of that particular strike price being in the money at expiration. So if I've got an option that's got a delta of 36 cents, that means to me that strike price has about a 36% probability of being in the money at expiration, which means that it's got about a 64% probability of being out of the money at expiration. That's okay, right? Because that says it's got a better chance of being out of the money at expiration than it has a chance of being in the money at expiration. And if we go to the other side of the equation, you notice that 126 strike that I sold also has a 36-cent delta. So that option has about the same probability. So we've created a range in which we expect the price of the stock to stay that is highly probable. We want to take advantage of that probability of the stock to stay within that particular range. And we create basically a delta neutral trade. Now, the other thing that we've got to pay attention to here is the passage of time. Remember, we're short the option that is more expensive and it has a higher theta. So we look at the option that we are short and it has a 7-cent theta, meaning every day that passes 7 cents is going to eat away from that short call spread or that short call. And every day that passes our 118 strike, we're going to lose about 6 cents on that side. But that loss is going to help us on the short legs. It's going to hurt us on the long legs, but it's going to hurt us less on the long legs. So we have a net time sensitivity on the put spread of about a penny a day. And we have a net sensitivity to time decay on the call side of about 2 cents a day. So overall, every day that passes, this option premium should be losing theoretically about 3 cents. That's working in our favor, right? That is working in our particular favor in this particular case. Now, the other thing to think about is volatility sensitivity. So we want the higher sensitivity to volatility be on our short legs. So if implied volatility goes down, our short premium is losing about 13 cents on the call side. It's losing about 10 cents on the put side. So net volatility sensitivity is about 3 cents on the call side. And if we look at our put side, it's also about net 3 cents. So if implied volatility goes down by 1%, then overall, this Iron Condor trade should lose about 6 cents per percent of implied volatility-based premium, right? So the Vega sensitivity of this trade net is approximately 6 cents. So if implied volatility goes down 1%, the premium should lose about 6 cents. Theoretically, it's not going to be absolutely exactly that, but it's going to be pretty close. Now, overall, this is a trade. If we kind of think through the sensitivities here in this particular trade, this is a trade that benefits from the passage of time. It benefits from implied volatility falling, and it benefits from the price of the stock staying within the range that we expect it to stay, in this case, between 126 on the upside and 118 on the downside. We've created that range. Now, let's think about how this trade might work. Let's pop this back up again, and let's go to our confirm and send button, and let's see the buying power impact. The buying power impact of this trade is relatively low. In fact, it's our max theoretical loss in the trade, simply because those two spreads together now have created that expectation that we know that the price of the stock can't be both above and below at the same time. So this is a smaller impact to that buying power, and thus a smaller impact to margin. Remember, margin in this particular case is a function of your particular account, but at the same time, in terms of that buying power impact, that's a function of the fact that this spread trade can't be both in the money on the call side and in the money on the put side simultaneously at expiration. So what's the goal of this particular trade? Let's go back out to our monitor tab for just a second, and let's take a look at this trade. So in this case, we expect that the price of the stock is going to continue to stay within that range, right? The navigational buoys, if you will, where we drew those lines on the chart. We bought this, we sold this Iron Condor for $2.62. And right now it's currently trading at $2.61. What happened, very likely, is that implied volatility went down a little bit, plus we've got some passage of time from when I put this trade on. Ideally, I want to be able to buy this spread back for less than the $2.62 that I was paid for it. Now, I could create an order like we did yesterday to take this trade on, to take this trade off in the event that the spread trades less than that $2.62. Now, that's my theoretical maximum gain in the trade. And a couple of people are asking the question, well, wait a second, what's the major advantage of doing this as an Iron Condor in lieu of two vertical spreads? Well, nothing. That's really the same thing. Now, when I put this trade on, what happens is the platform recognizes that I'm putting this on as an Iron Condor. But could you leg into the trade? Absolutely. You can sell one spread and then sell the other one. And we'll talk about that in terms of the directional movement of this trade. So what I could do in order to close this trade down, let's talk really quickly about management of this trade, is right click on this trade and create a closing order. Now I can buy back this vertical or this Iron Condor all at the same time. And if the price of the stock stays within the navigational buoys, if it stays in between our short strikes, then that works just fine, be able to close the trade down as we get closer to expiration. Or in some cases, if it's stayed right within that range and the majority of the value has gone out of that option premium, you may consider holding it all the way through till expiration. However, one thing to keep in mind is that the risk of being assigned on either one side or the other, the price of the stock moving one way or the other, does not go away until this trade expires. So you might collect almost all of that premium and you're trying to pick up that last nickel or 10 cents. And all of a sudden now the price of the stock makes a big move. And now you're in the money on one side or the other, and you end up taking that maximum theoretical loss in the trade. And you turned a winning trade into a losing trade. So keep in mind, if you can exit the position, if you can exit the Iron Condor, short Iron Condor, when it's done the majority of the work that it is designed to do, that may be a favorable situation to exit the trade. You can choose when you want to exit. But to exit it, we could buy that spread back as a whole. So what we could do is we can also set up a trade to automate this, kind of like what we did yesterday. But if we click right there on that trade, now in order to close this down, we got to buy it back. but I don't want to buy it back at 262 because that's what I paid or what I was paid for it to begin with. So I want to buy this back at some point when it's done the majority of the work that it can do for me. So I'm going to buy this back when it's trading at, I'll say 40 cents, right? Buy this back when it's trading at 40 cents or less. Then it's done the majority of the work that it can do for me. So I'm going to make that a good till canceled order. And that's a limit order. It says limit, which says wait until I can buy this back for 40 cents or less. Because remember, limit always says or less. And I can click on confirm and send, make sure that I'm putting this in the right location, make sure I'm aware of any alerts that might exist here, and click on send. And now that order is going to sit here in my working orders section, and it's going to wait until that Iron Condor trades at 40 cents or less total premium. And if that happens, then it's going to submit that order to close down the Iron Condor, buy it back for 40 cents or less, and then it's done the majority of the work that it can do for me. That may not get hit. This is one way to manage an Iron Condor trade. We can also manage the individual sides as well. We could close down. If we go back to that Iron Condor position here in the monitor tab, if we right click on that trade, here's our Disney trade, right click, create a closing order. One of the things that we could do is we could buy back the call vertical, or we could buy back the put vertical individually. We can break this apart, right? So William says some traders will exit when 80 to 90% of the maximum theoretical gain is achieved. Yeah, you can choose where you close that trade down. Now, here's the thing to think about. Some of you are asking, well, could we just put a stop order on this, right? Because I don't want to take that maximum theoretical loss. Well, just like we talked about last night, the possibility of this trade moving into that maximum theoretical loss position on, say, for instance, a volatile trading day, and then the stock stays exactly where it is, that is a possibility. If implied volatility were to jump up, this spread could trade to that maximum loss scenario. And so putting a stop order in that particular circumstance may kick us out of the trade when the trade is still perfectly doing exactly what it's supposed to be doing. This is already a risk-defined trade. We know what our maximum theoretical loss is in the trade, and so we're going to leave this potentially without a stop to close the trade down if it goes against us. If that's not acceptable, if you don't feel comfortable with that, then one thing that a trader might consider doing is adjusting the width of the spreads or the location of the spreads to manage that defined risk in the trade as opposed to putting a stop order on the trade, right? Okay, so as we put this together and we've set this order off and we've now created an order to close it down if it does the majority of the work that it can do for us. That's the one that's 31 days to go until expiration. Now, the other thing to think about is as we get closer to expiration, and I'm glad that Carlo brought this up, this doesn't have to be the end of the trade. We could conceivably roll this Iron Condor further out in time if the price of the stock, if we look at the chart of Disney and Disney continue to move sideways, we could roll this spread out either at the same strike prices and just roll it out, which means buy it back and sell another one at a separate expiration date. We could keep the same strike prices. We could adjust the strike prices as well and keep that. And you can roll those individual legs. So one of the things to keep in mind, however, is you've got a short leg on either side of this trade. So if you were to roll or submit an order to roll the long legs without rolling the short legs, there is the possibility that if that order did not fill, then you end up in a situation where you could be inadvertently naked in the short leg and not have that long leg to cover. So that's something to pay attention to as we roll a short Iron Condor. But we'll get into more of that management here in just a minute as we kind of get into some of these other examples. So that being the case, right, as we look at a trade like this, this is a delta neutral strategy. We can see what the price of the stock is doing. It's kind of moving in that sideways scenario. Let's go back to our monitor tab because I've put a couple of other trades together here. Let's choose the one that is a little more, a little closer to expiration. This is McDonald's. And again, one of the things to consider in placing trades, and especially in advanced option strategies, and we talked just briefly about it yesterday, is the idea of trading where the people are, right? Having good liquidity in these options. So trading something that is a liquid stock, trading something that has liquid options, right? That gives you the opportunity to benefit perhaps from lower slippage in putting the trades on. Now, here's the scenario that we're in with McDonald's, right? We've got an earnings announcement over the horizon just a little bit. In fact, it's the same date as Disney. And we see that implied volatility has come up. Implied volatility is on the rise, maybe flattening out a little bit here. But this is maybe a little bit more bullish in its movement. Now, it stayed now between this range. We've got a support level at about 290, and we've got a resistance level up here around 306 or so. So in constructing this particular trade that is maybe a little bit short-term, more bullish than Disney, because the price of the stock is kind of climbing that level of support, I put this trade together a little bit more bullishly, a little skewed, a little bit more bullishly, right? So let's put this trade together. Let's go to the trade tab for McDonald's, and we're a little bit shorter in time frame. And what I've done is I've given that stock a little bit more room, and I'll show you how we might construct this trade to be even a little bit more bullish. It's not as bullish. The trade is not as bullish now as it was when I put the trade on. When I put the trade on, the stock was a little bit lower. It went up a little bit today. In fact, it went up 3% today. $1.16, or actually 1.16%. It went up about $3 today. So it started to move in a more bullish direction. Where I was bullishly in structuring this trade when I put it on earlier today isn't quite as bullish now. So I'll show you how we'll adjust this trade a little bit. So let's start with the short strike on the put spread. We're going to build the put spread here. 290. That was our level of support. The price of the stock is currently sitting at 299. So that 290 strike is about the 30-cent delta, again, about the 30% probability of being out of the money at expiration, or excuse me, 30% probability of being in the money at expiration, about a 70% probability of being out of the money at expiration. So we sold the 290 strike, and I'm just holding my control key down, and I bought the 285, $5 wide vertical spread. I could go a little bit wider, right? I could go a little bit wider on this trade too if I wanted to, or I could go a little bit more narrow. I could close that gap on that side. And I don't have to be equidistant on either side. We can unbalance this Iron Condor a little bit. But notice when I create this put spread, I've got a credit of $1.06, which means on a $5 wide vertical spread, I've got a max loss of $3.94. Now, I'm going to delete that one for just a second because I want to go over to the call side for just a minute. We sold the 305 call for 470, and we bought the 310 call, again, $5 wide, and we brought in $1.72, not quite as much as we brought in on the put side. Click on confirm and send. $3.28 risk, max loss in the trade, $1.72 max theoretical gain. That's just for the short call spread. So I'm going to delete that now as well. Now let's put both of these together at the same time. I'm holding my control key down. I'm selling the 290, and I'm buying the 285. Okay, I've created the put spread. And I'm going to drop this back down. Now I'm going to sell the 305, and I'm going to buy the 310. All the while, I'm holding my control key down. And now I've created a trade that brings in a total net credit of $2.78. I click on confirm and send. I know that I've got a $5 wide spread on either side. So bringing in $2.78 against $5 creates a maximum theoretical loss of $222. A little bit more gain than I stand to lose in the trade. And then it also tells me where my break evens are. I want to show you really quickly one other way that we could construct this trade. Actually, there's two other ways that we could construct this trade. I'm going to use my control key as well. I'm going to hold my control key down. And the first thing I'm going to do is I'm going to create the short legs. You can do it this way too. I have a particular way that I do it just because that's my habit in constructing the trade. But you can also pull down an Iron Condor as a whole. We'll see that displayed as an Iron Condor. But one of the ways that you can create this trade is to do the short legs first. Sell the 290 and sell the 305. Now we've created a strangle. We're selling that strangle for $7.97. And if we were to leave it right there and we click on confirm and send, we have theoretically maximum theoretical loss, right? I mean, it is infinite loss because the price of the stock could go up or it could go down, and we have that potential theoretical maximum loss. But we're not going to leave it right there. So what we're going to do is we're going to come back and we're going to buy the 285 and we're going to buy the 310. And now we've created the Iron Condor, 278 of credit against a $5 wide spread. That's another way that you could build this trade and put the trade together. Sell the insides first and then buy the long legs, the outside wings of the Iron Condor, if you will. There's a lot of different ways that we could do it. We could, to Scott's point, or to Ray's point in the chat, we could sell the put spread first if the price of the stock was closer to that put spread, and then wait and sell the call spread later. We could leg into the trade. There's one other way that we could construct this trade that might be helpful. And I can come up here to where it says spread, and I can go back down here to where it says deep and wide and do a 1 month. We'll do 2 strikes in this case wide, because I think I've got 2.5. Yep, 2 strikes wide, Iron Condor. And now you see where those Iron Condors are displayed. And I can sell that Iron Condor. So here's the Iron Condor. And what I can do is I can use this to help me create the trade. I can simply look at selling it first, and then I can adjust the legs individually to what I want those legs to be. Right? That's another way that we can construct the Iron Condor. And you can also see, if you do it that way, you can see what the net Greeks are for each side of this trade. So the net Greeks on each one of these trades then is reflective of the Greeks of the short leg and the long leg. Did you guys say something? I didn't know if you, I thought I heard you guys say something. Okay. I think we're still good. Hi, Ray.
If you want us to, it's up to you.
Yeah, no. Hi, Ray. How are you?
Good, man. Just answering questions.
That's great. Lots of great questions here. Hey, you know what? We've been deep diving into this and putting this on. Maybe it's a good opportunity for us to take just a really quick sidestep here and pop back over here to our schwab.com/coaching page, right?
Good place to go.
Yeah, good place to go. schwab.com/coaching. This is where you can go to learn more about short vertical spreads, about Iron Condors. We've got some on-demand webcasts that talk about that. We've got our link to the in-person events, but we've also got this particular calendar right here for live webcasts and virtual workshops. And this is where you're going to find our whole schedule and calendar of the workshop, or excuse me, the webcasts that we teach, including our virtual workshops, including this virtual workshop that we are teaching tonight. So I'll give you an idea. Today was, let's see, where are we here? Today was the 22nd. So I taught trading futures this morning, and I taught getting started with technical analysis today. There's that one right now, and here's our advanced option strategies virtual workshop. So we teach 30 hours roughly of webcasts on a weekly basis on a broad variety of topics. This is a great resource. The other resource is our Trader Talks webcast page. And if you go to youtube.com/@Trader Talks webcasts, you're going to find this whole list of archived webcasts that you can choose from. In fact, if you want to learn more about Iron Condors, click on that little search button and type in IRON Condor. And once you type in Iron Condor, you're going to see tonight's webcast. You're going to see Barb Armstrong teaching Iron Condors, real-world examples. Brent Moore's teaching unbalanced Iron Condors and covered strangles. Iron Condors, Iron Condors, Iron Condors, Iron Condors. Lots of webcasts. Oh, by the way, here's 0 DTE Iron Condor examples ahead of the Fed. So I talk a lot about that in my trading index options webcast. So lots of resources when you talk about Iron Condors. We would love for you to click on subscribe. You can also click on subscribe down at the bottom of the page there on the YouTube screen. That's going to help you stay connected to the Trader Talks webcast channel and be able to learn a little bit more about some of these strategies, right? Learn a little bit more about Iron Condors or short vertical spreads and give you some additional resources. Now, talking about additional resources, there is another additional resource that I wanted to bring up, and I wanted to pull this because I know that this question, and I know Ray and Scott, you guys have been popping this into the chat, but this is where you find the resources for this particular workshop. And you've got that customized, personalized event hub that you can link to from the email that you were sent to confirm this webcast. And that personalized event hub gives you the information about the previous sessions, gives you the information about the upcoming sessions, shows you where you can join live, shows you the countdown timer to the next session. That's going to be tomorrow night. We're going to be talking about calendar spreads. And then the one on Thursday, diagonal spreads, where you can join live and all of those great resources. Now, if you come up to the top of the page, you're going to see a couple of things. You're going to see that resources tab right up here at the top of that event or this event hub. And that's going to give you the opportunity to download the reference guide, to look at some of the on-demand webcasts around option strategies, to talk through the course or to go through the course on non-directional options, those advanced option strategies ideas. Here's how you find the Schwab Coaching YouTube channel. Here's how you find the Schwab Network. Again, remember the Schwab Network is brought to us by our media affiliate, Charles Schwab Media Productions. And these are some great resources. These are some great resources to help you to be able to reinforce what you are doing. So these are, again, some very helpful tools that you can use for extending your education beyond just this particular virtual workshop. These are being recorded, as several of you have asked. Those recordings are going to be available right here in your event hub. And as soon as those are dropped, you can watch those. I know that about 6,000 of you took advantage of the opportunity to watch last night's replay. So thank you very much. We appreciate you doing that. That's awesome. Thanks for joining us for those for those replays. And that's something that we have not done before. So you guys get the benefit of that additional resource. So let's pop back over here to the Thinkorswim platform and let's talk a little bit more about these strategies. Let's talk about some of the considerations as we build these trades. So I'm going to pop back in here. We're going to go to the monitor tab. So we've looked at a trade that is 31 days to go until expiration. We've looked at a trade that is 24 days to go until expiration. I've also got one on here that is 10 days to go until expiration. So what I want to kind of think about in this scenario, I'm going to close that down just so that I can use this as a whiteboard. When we talk about Iron Condor trades, one of the considerations is the duration to go until expiration. We talked about DTE, right? And so if this is expiration, and this axis right here is time, right? Time to go until expiration. And this axis right here is our option price or our option premium. Here's normally what happens. Normally what happens in an option is we get this kind of typical curve of time decay that accelerates as we get closer to expiration. So if we are the seller, net seller of premium, we're benefited generally by a more rapid passage of time. So last night when we were talking about long vertical spreads, we were looking at buying those long vertical spreads with a little bit more duration. We were looking at buying those long vertical spreads maybe out here on that curve where that curve was relatively flat. So if we're the buyer of an option or we're the net buyer of an option, we may want to consider being out there on that flat portion of the curve. And where that exactly is up to you in terms of that time frame. You might consider buying a vertical spread, being long a vertical spread, or buying an option somewhere, 50 to 150 days out from expiration. That might give enough duration that it slows down that time decay. But if you're the net seller of premium, you want to be potentially at this level right here, at this area where that rate of time decay has started to accelerate. Yeah, Brian, you're right. You've heard me sing that before. This E is on fire. That rate of time decay accelerates as we get close to expiration. Now, given that, that means if we're selling an Iron Condor, the closer we get to expiration, theoretically, the more sensitive that trade should be, the more it should benefit from that passage of time. So if we're the net seller, we might want to consider selling 40 to 20 days prior to expiration. But you could go closer. The trade-off in selling closer to expiration, and this is my balance beam, the trade-off in selling closer to expiration is the amount of premium that we are considering or able to bring in, because the closer we get to expiration, the more those premiums have decayed away already, and the less premium we are able to collect. So we sell a little bit more time, we're able to get more premium, sell a little bit less time, rate of time decay is accelerated, but we're able to bring in less premium. So there's a trade-off, as there always is, in putting together an Iron Condor. And these are some of those considerations in putting together an Iron Condor. So let's do this. Let me kill those annotations here really quickly. Let's come back over here and let's open up our Advanced Options Virtual Workshop group right here. We've got our Disney trade, which we've talked about. We've got our McDonald's trade, which we looked at. Now let's take this one, which is 10 days to go until expiration, a little bit shorter. And we might put this trade together and look at adjusting this trade. So let's look at the chart really quickly for Deckers Outdoor, DECK, Deckers Outdoor. And what do you notice about this particular stock is it's been in a downtrend. It's been bouncing kind of along this level of support here. And it's got a bit of a resistance level up here, right? So about the 112 and about the 94, 95 level of support. And guess what? There's an earnings announcement kind of right over the horizon here. We can see that that's on the 24th. That's in fact Thursday. So there's an earnings announcement coming up here pretty quick, which is one of the reasons why implied volatility is a little bit higher here, isn't it? Implied volatility in this particular case is at the 63rd percentile. And you notice where implied volatility normally has been in terms of those highs. This is not the highest that implied volatility has been, nor is it anywhere near the lowest. So the expectation is implied volatility is high and falling. That was one of the reasons why I considered looking at this as an example for putting this trade together, high and falling. So I'll show you the trade that I put together to begin with. We'll look at the monitor tab and we'll go back. And I sold the 98 put and I sold the 112 call. That's the range that I expected the price of the stock to stay within. If we go to the trade tab for Deckers Outdoor, this is 10 days to go until expiration. And you can see where, let me take this back to singles. Okay. you can see that I'm well out of the money on both of these legs. Our short leg on the call side is about the 39 cent delta, almost 40 cent delta. The short leg on the put side, that 98 strike, is at about the 29 cent delta. But what I also noticed is that that 98 strike, if we go back and cross-check that against the chart, I've got a support level here at 95. 98 is going to be here pretty close to the price of the stock. The stock's currently trading at 105, right? And if that's the case, and I've got an earnings announcement coming up, this vertical spread that I created might be a little bit too narrow. This range that I've created might be a little bit too tight, a range around this price of the stock. So let's create another one. Let's create another vertical spread or another Iron Condor around this price, knowing that we've got a level of support here at 95 and we've got a level of resistance up here at about 112. And we'll use that area as a means to put our spread together. So I'm going to kill that annotation so that we can come back and we can take a look at our option chain. We'll go to the trade tab once again. And I'm even going to go for this one, I'm going to go a little bit shorter because I know I've got 3 days to go until expiration. I've got an earnings announcement on Thursday. These options, the 25 July options, are going to expire on Friday. So notice what's happening to implied volatility here. Implied volatility is at 153%. It's ramped up because of that earnings announcement. So we're going to create a wide Iron Condor, and the fact that that implied volatility is higher allows us to create a wider Iron Condor and still bring in a reasonable amount of premium. But it's something to pay attention to. This is not one to just set and forget. In fact, none of these trades are a set it and forget it type of approach or a type of strategy. But this is an approach that suggests we've got to pay attention. So I'm going to increase the number of strikes that my option chain is showing. I'm going to increase to 50 strikes, which means I've got 25 up and 25 down. And I'm going to look for a couple of different things here. The first thing I'm going to look at is this expected move, $11. So I'm going to stay kind of right within that range. So the stock's currently at 105. I'm going to just take my calculator here and say 105 plus 11 is going to put me at about 116 to the upside, and 105 minus 11 is going to put me at about 94 on the downside. So 111 on the top side? Or what did we say on the top side? Oh, because we're currently trading at 105. Yeah, 111. 111. Whoops. Let's just do that again. 105 plus $11. That's the expected move. 116. Okay. 116 and 94. So let's look at where those levels are. 116 and 94, where that expected move is. Here's 94. That's about the 18-cent delta. So this is going to be wider than the one that we created that was at about the 30-cent delta. So if we sell the 94 and we buy, let's go two strikes wide. Because somebody was asking me the question, well, why are we going so wide on that vertical spread, or why are we going so narrow on that vertical spread? I'm going to go 2 strikes wide just to see what kind of premium we can bring in. 47-cent credit against a $2 wide vertical spread, which means if we left it right there, 53 of risk against $47, or excuse me, 47 cents of premium, or $47 of maximum theoretical gain against $153 of maximum theoretical loss in the trade. So we're going to keep that part in place. And now we're going to say, look, that's well below. If we sell that 94, that's right about where that expected move puts us. And it's below our level of support. So that level of support may act as a defense against the price of the stock moving lower. Now, that's the first side. That's the put spread. Now let's come over to the call spread. We said 116. So if we go to the 116 call spread, that's about the 27-cent delta. So this is maybe a little bit more bullish. So we could even afford perhaps to move this a little bit further away. We don't have to be within that range. And if we had an expectation that the price of the stock was going to move bullishly on that earnings announcement, we could adjust this spread out a little bit more. We could go out to, say, for instance, the 20-cent delta, and we might even bring in about the same amount of premium. Let's go to the 20-cent delta, which is the 120 strike. That's giving it more room to the upside. And let's buy the 122. So keeping with that $2 wide vertical spread. Now we're bringing in 75 cents of credit against a $2 wide total risk. Notice that our credit went up, our risk went down a little bit in the trade. $75 of risk of gain, $1.25 of risk. So let's do this really quick. Let's right click and send this to the Analyze tab. And you can see how wide that range is on this Iron Condor. So here's our expiration. This shaded, gray shaded area is one standard deviation above or below where the price of the stock currently is. I'm going to set my break evens to those points at expiration. So as long as the price of the stock is between 93 on the downside and 120 on the upside, I'm within that range. Those are my break-even points. And as long as I'm within that range, I'm making something on the trade or breaking even, theoretically. Now, what happens if the price of the stock makes a big move to the upside? What's going to happen to that put spread? If the price of the stock goes way up, that put spread is going to be near worthless. So could we close it down? Yeah. What happens if the price of the stock goes way down? That call spread is going to be near worthless. So we could close that call spread down, and we could either close it and stay away from it and just say, fine, we're going to walk this all the way through expiration, or we could roll that out to another expiration further out in time. There's a lot of things that we can do with managing Iron Condors. So remember, this number right here, that's profit and loss on the trade. These numbers down here along the bottom are stock price. So we've created a trade here that is highly probable. We've given the stock a wide range to move. Now, you see these slices right here where I put those break-even points, 93.26 and 120.75? I'm going to come over here to the right. I'm going to click on Set Slices to Charts, and I'm going to put those slices on the chart. And you can see those labeled right here, 120 and 93.26. So notice that 93.26, that break even is below my support level that I've drawn in, and that 120.75 is above my resistance level. But I've given it more headroom to the upside in the event of potential upward movement. And this is a trade that benefits from, A, the passage of time. We only have 3 more days to go in this trade, and it benefits from that drop in implied volatility, which is already starting to drop. And if implied volatility begins to make that move to the downside, or it makes that collapse after the earnings announcement, and the price of the stock stays exactly where it is, cool. If it stays within that range. If the price of the stock moves above or below one of my vertical spreads, if it moves above my call vertical spread or below my put vertical spread, I can manage this trade by taking the other side off and rolling the threatened side out in time or strike price. So I have a lot of flexibility in terms of how I can adjust this vertical spread. And the way that we could do that, again, as we go back to the Monitor tab, right-click on the trade, create a closing order, or create a rolling order. Remember, rolling is not a magic wand. It just simply is a convenient way to move a trade or to adjust a trade. It means that you close one down that you're already in and open another one. But we could create a closing order to buy this vertical spread or this Iron Condor back as a whole. We could create an order to buy back the call side, to buy back the put side, or we could take those short legs off and leave the long legs in place too. A lot of different ways that we could approach closing this trade down. So what I'm going to do really quickly before we go and before we wrap this up is I'm going to put this trade on. I'm going to do what we did on that Disney trade. And I'm going to say, look, we're going to close this down if it's done the majority of the work that it can do for us. We brought in, when we put this trade on, $1.22. It went up today because the price of the stock, or actually implied volatility, kind of went up, and one side or the other became a little bit more expensive. In fact, I think the call spread became a little bit more expensive because the price of the stock went up a little bit. So I'm going to put on an order to close this trade down like we did before. We're going to buy this back if it's done the majority of the work that it can do for me. And I'm going to buy this one back in this particular case. I'm going to create an order, a limit order to buy this spread back, this Iron Condor spread, if I can buy it back for 30 cents or less. And I'm going to make that good till canceled. And then I've potentially gained about 80% of the maximum theoretical gain in this trade. And I have the possibility of closing this trade down prior to expiration for the majority of the work that it can do for me. I'm going to click on confirm and send, read through this order, make sure that I'm aware of that, and I'm going to go ahead and I'm going to click on send. Now, some considerations to think about, and I'm going to pop back over here to our slide deck for just a second. Some of the considerations to think about in putting this trade on. Money management is a concern, right? Because you have 4 legs of this trade. And because you've got 4 legs, it is going to have higher transaction costs. So you've got to be aware of that. You've also got to keep in mind the number of contracts. If you start to ramp the number of contracts up to increase the amount of premium that you're bringing in, you've got to keep in mind the amount of trade risk that you have in the trade. Now, the other thing to think about in terms of exit considerations, if the trade is in the money on one side or the other, consider having some patience. But if you're getting closer to expiration, you're 4 to 10 days prior to expiration, close the other side down and manage the one that is being threatened. Now, if both of them are out of the money, if it's staying right down the middle of the channel, consider closing it down 4 to 10 days prior to expiration, or closing it down if you've reached your profit target. A couple of different ways that you could manage that trade. Some of the pitfalls, however, depending on how you structure it, if you structure it really wide, so it's a highly probable trade, that potential return, the amount of premium we're bringing in, could be much smaller than the risk, especially if implied volatility is low. If implied volatility continues to go up, that makes it more expensive to buy those vertical spreads back and eliminate the obligation and take that trade off. Rising implied volatility works against us. Now, if you end up in between the legs of a spread, one side or the other, that is something to pay attention to. And you might consider closing that side down and adjusting the other side of the trade. And early assignment is something to pay attention to, but it's not something to be afraid of. You know that if you're assigned on one of those short legs, you've got a long leg. As long as it's before expiration, you've got a long leg that you could choose to exercise to manage that trade, or simply buy the stock back, or sell the stock to manage the obligation in the trade. Remember, these are multiple leg trades, so they are going to have higher transaction costs. And there's what we've talked about with Iron Condors. Tomorrow night, we're going to be taking advantage of a strategy that is fairly similar to the Iron Condor, in that it creates a range and where we expect the price of the stock to move, but it splits time and not strike prices. So we'll see what that looks like. Guys, there's a feedback survey out there in the chat right now. Ray and Scott, you want to talk a little bit about this? I've got the slide up here that talks about where we're going to be next, but I'm going to let you guys jump in here real quick, and as we're real close to time here.
Hey, Scott, you're on mute.
Again, great job again tonight, Ben. And to reiterate, gang, don't forget to fill out that survey. That link's been there. We, for those of you who are in the area or willing to travel, I know Brian and many others do travel between events. We'll be in Chicago. That's the August 15, 16. That's at the Renaissance Schaumburg Convention Center. I think that class is a technical analysis and option strategies class. The next class after that will be in Washington, D.C. That's September 12, 13 at the Ritz-Carlton. Same type of a class in Dallas on September 20th at the Gaylord Texan. If you've never been there, it's a treat. We'll be doing a market drive. That's a one-day class. Gang, it's been a great night being with you tonight. Please don't forget to join us again tomorrow night. We'll be doing this again, same bat time, same bat channel. Don't forget to fill out that survey. Have a great night, everybody.
Thanks, everybody. Take care and have a good night. We'll see you tomorrow afternoon.
All right.